Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in. Take a look, see what's going on today. If you want to follow me, it's at @finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, sectors, investments, and sharing those opportunities, investments with everyone in the community. We do have a special going on. Special is the coupon code in the lower left corner there. You can get a 50% off discount on the first month only on a monthly membership, and you can get a $100 discount on a yearly membership if you'd like to sign up, or you can switch from a monthly to a yearly and get that discount. So starting off with Mark Zandi, he says there's an uncomfortably high 48% probability that the US economy will suffer a recession in the next 12 months. That's according to Moody's recently unveiled leading economic indicator, derived using a machine learning algorithm on our extensive database. It's less than 50%, but historically the probability has never gotten this high, and a recession has not ensued. I'm wondering if the slowdown's already behind us. Could it be ahead of us? It still could be ahead of us. One of the leading indicators that I like to watch is housing starts, housing permits, U.S. construction workers. All of those things are things that we can monitor. And they do look like they're rolling over to some degree. So that's something that we can definitely watch. What the what the Federal Reserve did was they raised interest rates to a pretty high level to kind of slow down bank lending, basically to slow down the real estate market. And that worked. We saw home sales slow down, and then we basically are starting to see now U.S. construction employment kind of level off and maybe roll over. We'll have to continue to watch that. And housing starts and permits have leveled off and maybe even receded some. So, in order for them to basically slow down inflation, they need to increase unemployment. So, what I think they were doing, and this is just my guess, is they said, you know what, this is how we'll do it. We'll kill bank lending, really slow down the housing market, but in the back, we'll continue to print money fiscally. So, they keep pumping money into the system fiscally, which then they basically can control the gross domestic product. GDP is a function of transactional value, and then they have an inflation component. If you understate inflation, you overstate gross domestic product. So I think what they did is they said, okay, we'll kill bank lending and slow the system down from that aspect. We will get to control where the money goes in the system, aka fiscal spending and that type of thing. And we'll understate inflation, overstate GDP, and then the unemployment numbers we can kind of like fiddle with them and kind of do what we want. So I think that's what happened. And now they're like, wait a minute, we're going to dial back, jacking around with the numbers. I don't know what they're doing with the numbers, to be honest. Maybe we're getting legit numbers, maybe we're not. But I think it's all done based off of them being able to keep the rates high for longer, kind of slow down inflation as much as they can from bank lending. And then the fiscal spending just keeps basically the pedal on the metal, not maybe to the metal, but the pedal is still engaged for inflation. And then they just manipulate the numbers the way they see fit. There was another post a while back. This was probably a month or so, or half a month or so. And it said analysts did not trust the numbers that were being released, the data. And that was a while back. So, that's stuck in my head since I've read, I go through these things so often. If they don't trust the data, and let's say that the data is just all being jacked with, who knows what the real numbers are? Who knows what GDP is? Who really knows what inflation is? Who knows what these unemployment and employment numbers are? They're just making it up to some degree. And you know, uh, when I was going through school, a lot of that, just in general, I felt like a lot of stuff was just made up. Like a lot of the English classes and history classes. It brings me back to like those classes where uh, your grades were very subjective. It's like these numbers are all subjective. You can make inflation whatever you want it to be. You can make GDP whatever you want it to be. And they were jacking with the job numbers. So it's like, well, they can make that whatever number they want to be, apparently. So what do you have to really go off of? And if you're an investor, the only thing you could go off of now is basically the charts. That's it. All these numbers are cooked. They're cooking them. So I don't know. Could we be in a recession? Could we not? If they want it to be, if they want to try to drive demand into bonds, maybe that's how they do it. Maybe they throw out there that we're going to go into a recession. People get really worried. They start to buy more bonds, and they're like, "Ha ha ha, we got you where we want you." And then they just direct money flows towards the bond market to scare people. Kobayashi letter says this is historic. Newly released data shows that U.S. household net worth jumped by $7.1 trillion in quarter two 2025 alone. Alone. In other words, for 3 straight months, U.S. households added an average of $79 billion in net worth per day. What just happened? Let us explain, and let's see what they have to say here. The Fed just released their latest Z1 report, as shown below. Total U.S. household net worth hit a record of 176.3 trillion in quarter two 2025. 7.1 trillion quarter over quarter increase marks the largest dollar increase since quarter four during the pandemic recovery. Such a large jump is extremely rare. In fact, U.S. household net worth is historically high relative to GDP. Household net worth now equals 581% of US GDP, the highest since quarter one of 2022. The wealth gap between asset owners and everyone else is widening quickly. The stock market was largely behind this gain. Furthermore, the S&P 500 just completed one of its best 5-month rallies in history. The S&P 500 rallied over 30% in 5 months since April of 2025. Since 1975, there have only been 5 previous times in history with a 30% plus rally in 5 months. 2020 and 2009 were the most recent. These were big pump years, if you guys know that. Are we getting a big pump here? Like money coming into the system pump. As a result, the rich are getting much richer. Currently, the bottom 50% of US households now hold just 2.5% of total US wealth. In fact, the top 1% now holds 40 trillion more wealth than the bottom 50% combined. We expect this gap to continue to widen as rate cuts begin. The reality is that the rate cuts are coming into a weak labor market with 3% plus inflation. A record 70% of consumers believe their income will fail to keep up with inflation. As inflation rebounds, asset prices will follow, and asset owners, the top 10%, will reap the rewards. This is the cost of living fear. And history says the stock market rally is young. In the 5 previous times the S&P 500 rallied 30% plus in 5 months, the next 12 months were always green. Since 1975, the average 12-month return after such an occurrence is 18.1% per Carson. Not to mention rate cuts are here. Rate cuts are coming up with the S&P 500 at record highs. In the last 20 times this has happened, the S&P 500 rose an average of 14% over the next 12 months per Carson. With stocks up 30% in 5 months, there has never been negative returns in the following 6 months since 1975. We believe all of the data suggests that asset owners will continue to reap the rewards. This week, for the first time in 30 plus years, the Fed will cut rates with PCE inflation above 2.9%. The Fed will be cutting rates into hot inflation and blame a weak labor market. And this also means that we expect U.S. household net worth to hit more record highs. We believe U.S. household net worth will exceed 200 trillion by 2027. The Fed is adding rocket fuel to an already hot equity market. Those who do not own assets will be left behind. Changing monetary policy is coming into an evolving economy. The market is shifting, and its implications on stocks, commodities, bonds, and crypto are investable. Want to receive? Yeah, it's fine there. So that's where we're going to end it. So yeah, they're cutting into a hot market. And historically, when they have done this, it is showing that we have continued to move higher. I see the recession calls, this, and then I paired it with this that I found out there, which is a bullish case for at least the stock market. So that's the situation. It's those two kind of back and forth. Could we get a recession where the stock market goes up? It's possible. Dividendology. The best time to plant a tree was 20 years ago. The second best time is today. So this is compound interest. Who will earn more? There's two examples. Investor one starts at 25 years old, sets aside $5,000 a year for 10 years in a row. No more investments after age 34. So her investment is just this little beginning portion there. And that grows to 787,000 at age 65. Investor 2 has a later start. Starts at 35 years, which is 10 years later, invests $5,000 each year for 30 years instead of 10 years in a row until reaching age 65. Since he started later, 10 years later, and even though he invested a lot more money because he put 5,000 in for 35 years versus the first investor who only invested 5,000 for 10 years. The second person, because they didn't enjoy as long as compounding, could not keep up or catch up. The 25-year-old investor was at 787,000, and then the 35-year-old investor who started later was 611,000. Compounding does the heavy lifting over all the years. I did this. I put as much money as possible as early as possible. I put a whole bunch in when I was in my early 20s. So I didn't start at 25. I started at 22, 23, right when I started working. And I pumped it as much as I could in the beginning. I probably had well over 100 grand by age 25, 26, 27, somewhere in that range. Well over. And then I let it compound. So that's how I got into the situation that I am. And I never let off. I kept my foot planted to the ground in terms of savings for as long as I possibly could. And I put it mainly in 401ks, which were tax deferred investments. That's where I put the majority of it, and I just kind of maxed it all out. I did save outside of it too, but that was the majority. So what I did is I put it in a 401k because I was working, and then I got a match too, so that was great. I got like a 6% match or something like that. And then I put it in a Roth 401k. or Roth IRA, sorry, not 401k, a Roth IRA. And that's where the bulk of my money went. So I maxed out that, and then I maxed out my Roth IRA, and then I had a little bit of in a brokerage account that I have for like, I had an emergency fund, and then I had a little bit in the brokerage account for extra money in case I needed it, and then I just grew it from there. In my 30s, I didn't save as much because I had to pay for kids and buy a house. There's a lot of other things that I had to pay for in my 30s that I couldn't save as much. So I'm more closer to investor one, where I had a lull in my 30s, in terms of how much I could put in. Gold versus SPX. What's the potential upside for gold relative to stocks? It could be a very big move. We're still in a rounding bottoming pattern. It's a 15-year bottoming pattern, it looks like there. We are starting to come up on the right-hand side in a flag pattern that looks good to continue higher. So yeah, we could see a very big outperformance of gold versus the S&P 500 equities. This is the platinum to palladium ratio. Uh, I put all the platinum ratios in the other one, and I forgot to put the palladium one up, and some people ask about it, so I put it up. Um, I actually did buy palladium in 2005 and 2009. Luckily, I did. It was very low, and I was like, I I started investing around that time frame in 2005. So I started working in 2004. I started investing, and then I was like, you know what? I'll put some in precious metals. It was the big Mike Maloney era, and I was getting interested into silver and stuff like that, and palladium was there. I was like, man, palladium looks really cheap, and I just looked at like charts pretty basically back then. I did add, I did buy some in 2005. It wasn't a lot. It was very small amount. And then in 2009, when it crashed back down in 08, 09, I added a little bit more because it was so cheap. It was basically back to where I bought it in 2005. So I bought some more there, and I wrote it for the entire way down. And I swapped it into platinum right at the bottom in 2020. In April of 2020 is when I did it. The premiums are really low. I was thinking about swapping my palladium into silver. The ratio there was also very attractive. But the premiums were huge on silver. It seemed like everybody was buying silver, but nobody was buying platinum. So I negotiated a pretty good deal with a very, very low premium on platinum. So I did the trade there. I swapped all my palladium for platinum in April of 2020, and it worked out. It worked out quite well, as palladium was expensive, and on a ratio perspective, it was really, really low. I almost got three. It was a little less than 3 ounces of platinum for palladium. It was like 2 point something, 2.6, 2.75, whatever it was, somewhere in there. Um, so I was pretty happy about that. Um, Charlie Munger says extreme patience combined with extreme decisiveness. You may call that our investment process. Yes, it's that simple. So what does that mean? What that means is you basically collect money, you wait for a potential mis we'll call it a valuation that's just completely mispriced. If we can get fear in the market, then when they see it, they just pounce on it. That's what that means. It means that they're really patient to wait for an opportunity. And then when the opportunity comes, they strike when the iron's hot. That's their what they call their investment process. So they've got a watch list. They know the good companies, they know the bad companies that they don't want. They watch their four, five, six, seven good companies that they want to buy. They wait for the market conditions to be really negative for that company, and then they pounce on it. That's what they do. Scott Bissett says faulty government data hid weak jobs, pushing Fed to cut. But same data understated inflation, meaning the Fed's been too loose and must hike. I don't know if that's the case, but that's kind of what's going on here. And I have no idea if that data is correct or not. I don't know if they're releasing it on purpose, trying to push the Fed to cut, or or what. I don't know. I really don't know. Here's Davi. He says a compelling chart for silver. The outperformance of hard assets over financial assets is, in his view, one of the most significant macro trends unfolding today. While we've seen similar shifts in the past, years of prolonged underperformance have conditioned investors to dismiss the possibility of sustained reversals. I take the opposite view. As Mark Twain famously said, history doesn't repeat itself, but it often rhymes. By the end of this decade, I believe traditional portfolios will likely hold a meaningfully larger allocation to hard assets than they do today. This is silver to the S&P 500 ratio, and it's bottoming and turning higher, where silver is undervalued versus U.S. equities. And this was a great time in history to do the same thing that we're doing today was in 2000. 2000, silver was completely underpriced. So was gold. Go back to the year 2000 and look at what gold was priced at. Unbelievable. So we're in the same situation today as then. And the valuations on the S&P 500 are ridiculous. The valuations on silver, they were ridiculously cheap. They're still cheap, but it is getting more expensive as silver continues to go up. Posted this Barrick chart 4.5 months ago, right before the massive blue breakout, and link post below. Up 50% since then, I hope you notice. This chart is a proxy for the sector, and it is showing the way. Underestimating this chart is not a very good idea. Odds are very high that this massive pattern will play out, and it is broken out, so it's now happening. These kind of sector moves, they do not come around every week. So for heaven's sake, make the most of it. So there's the actual target, very, very high away. He's got the same problem, I think. We see these gigantic patterns. I see them all over the place, these big fractals. Barrick is just one example of it. You go and you put your large arrow, like this is the lead-in move he's got as a potential we'll call it a breakout and price target. The target is so ludicrous how high it is that sometimes I'm like, it's just way up there. Like, I don't know if I believe it, if it should. I do believe it deep down that these targets are ludicrous. I just don't want to come off sounding crazy. I don't want to come off sounding crazy. Um, if someone in 2009, after coming off a crash, we're going to tell you what NVIDIA did as a return. If they said, NVIDIA is going to pull like 134 bagger from where we are today, the majority of people would not believe it. They would not believe it. They say, oh, yeah, right, go screw yourself. And the majority of people, even if you told them the compelling case that artificial intelligence is going to come uh, like a decade and a half away, and it's going to go up and be absolutely incredible, they wouldn't believe you. And I think there would be almost zero chance for the majority of those people that if they were to purchase NVIDIA, even in 2009, 10, 11, like towards that bottom, I'm willing to bet they couldn't hold on the entire way. It's the same thing that we're going through right now in silver companies and gold companies. It's the same thing. And I think even Grady and myself, if we were to say, what do you honestly believe? And we were to tell you, look, this is just like Nvidia at 2009, but in gold stocks, people would say, yeah, right. There's no way. I think in the majority of these commodity sectors that we are at the beginning of the bull market, and that we are very similar to the year 1998, 99, 2000, 2001, in that type of area based off valuations. And that NVIDIA type moves could come in some of these equities where we go up a hundredfold. And people would say, yeah, right. And even if you were to educate them as best as you could, that the majority of people couldn't hold that long. They couldn't make money in the stock market. They couldn't accept a 100 bagger, even if you gave them the most compelling case. So the people who make this money, they do deserve it if they can hold on and ride it. They do deserve it. And this is the last one here. It says commodities versus the S&P 500 remain at historic lows. Soon, a setup for the next super cycle. Surely this sluggishness can't last forever. And this is the big commodity bull market in the 70s. It went up. We did have a recession, so it cruised in through that recession. If you notice that commodities went up dramatically during the recession. We came back down, and then we went up again. It was a multiple wave movement. 1980s right here. We had another big move from 87 all the way to 1990. 90 was another recession. We had another big move from 2000 all the way up into 2008. We can see a clear three-wave pattern. One, two, third wave, and then the fifth. This wave here, is very similar to a lot of the fractals that we have in individual companies today. This fractal right there. I see it all over the place. And I think we're going to enter wave 3 here, and where we come way up in this ratio. So that's kind of what I'm seeing there. And we're still at a very, very cheap commodity to stock ratio. It's cheaper than 2000 and it's cheaper than 1970s, the beginning of that bull market. Very, very good opportunity here. But that's all I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you like, special coupon code, and that's all I've got for today. We'll catch you next time, guys. See ya.